Mr. Manish Jalan. Let's have a huge round of applause for him. Mr. Manish Jalan will be talking about statistics, the steps from technical analysis to algo trading. Mr. Manish Jalan is the Managing Director and co-founder of Samsara Capital Technologies, LLP. He has over 9 years of expertise in the areas of profitable, systematic, quantitative trading strategy development and is responsible for development of algorithmic trading and investment products. So let's have our next speaker and let's hear from him what he wants to say. Let's have a huge round of applause for Mr. Manish Jalan. Thank you.
Good evening, everybody. My name is Manish. For the next 1 hour, what we are basically going to do is cover statistics and algo trading. Well, not really algo trading, but idea is basically to identify, statistics as basically the main building block or the bridge between technical analysis and algo trading. So I would basically not be talking too much about algo trading, but talking too much about the statistics part. I'm sure technicals is already being taken by a lot of other speakers, so I'll not be getting into the technicals part. I would like to begin my speech, first of all, by thanking ATMA, BSE, Mr. Sushil Kedia, Mr. Chauhan, and all the members of ATMA who have been kind enough to give me this opportunity to talk for the next 1 hour. I would like to begin my speech by following a very old Chinese proverb. There's a very common saying in Chinese. It says that most of the battles are won or lost even before they are fought. What it basically means is that, when we are in the markets and when we try to put a trade, most of the time, the entire psychology behind basically putting the trade itself is made in such a manner that we can either lose the money or make the money even before we are actually putting the trade. Idea is, it is already known at the back of your mind that, whether the trade would be successful or not based upon, whether your entries was right, whether your exit was right, but based upon, what kind of work have you done behind taking that particular trade. What I'm trying to basically say is that, going back to the Chinese proverb, if you're in a battlefield, all right, if you're in a battlefield, most of the time what happens is there are two ways of basically preparing for a battle. One is you enter into the battlefield and you don't know where the enemy is coming from, you don't know where the attack is going to happen from, and wherever it happens from, you're just there to basically replicate to that. The other way of basically preparing yourself for a battlefield is, even before you enter into the battlefield, you know exactly where your enemies are going to come from, what is the likelihood of the kind of weapons that you need to take along with you, what are the kinds of instruments you need, if the enemy is coming from side A or side B. My dear friends, idea here is the same, that, before you enter into a trade, before you actually enter into an investment strategy or a trading strategy, it is not just about the entry point. It is not just about the exit point. Because if you're looking at only the entry points and if you're looking at only the exit points, you're missing out on the larger picture of how to basically tackle the battlefield. All you're doing is basically trying to say that if the enemy comes from A, I'm going to attack him from here. Idea of basically amalgamating technicals plus statistics plus algo is to take this entire thing one step ahead and say that, even before I take a trade, I know exactly what I'm going to do with this particular trade throughout the life cycle of the trade. From that, what I basically mean is that you know exactly that if market does A, I'm going to do B. If market does B, I'm going to do C. And these things are decided not after you take the position. These things are decided even before you enter into the position. Most of the time what happens is, after we enter into the position of a particular trade, more often than not, it is the psychology, it is the emotions, it is the M2M loss, it is the stop loss. These are the kind of things which starts guiding our discipline. And we would have taken the trade by getting entire gamut of technical analysis correct, entire gamut of rules-based things correct. But at the end of the day, we fail. And the reason why we fail is we are not prepared for the consequences of what the market can do extra. Idea here of basically using statistics is to take that one step ahead and to tell you that, what are the other things we really need to look into besides just the entries and the exits based upon technicals that can help us prepare for this entire battlefield so that, we can win or lose, the battle even before we basically go ahead and fight it. Right? That's basically the idea. What I'll do is I'll just take the next 5 minutes of yours to help you understand, what algo trading is, because, ultimately what I would do is make a bridge between technical analysis, which you are already aware of, statistics, and then basically take it to the algo trading front. Now, obviously, all the people here would have a difference of opinion in terms of what really algo trading means. And I've been in this field for the last 10 years. To me, basically, algos don't mean hi-fi computer systems, servers, co-locations, high-frequency trading. It doesn't mean any of these things. And if you think that, algos are really for computer geeks, for people from IIT, for people from IIMs, and, people who basically have got millions of dollars to invest, well, let me tell you, my friend, you are wrong. Idea here is, algo trading basically just simply means having a set of rules and following them with discipline. Now, if you can have set of rules, and I'm sure Mr. Vivek, I just happened to attend his session, before mine. He had already explained so many rules regarding retracement levels, regarding, triangle breakouts and things like that. So rules are always there, they are always there. It will come from technicals, it will come from your entries, it will come from your exits. Idea is once you have these rules, how can you make a complete end-to-end system which is not just about the rules, it is about the risk management, it is about the portfolio optimization, it is about using the right kind of statistics, it is about using the right kind of parameters which can just help you take that extra leap where you already know the technicals, but to convert that into a profitable part, right? That is basically where the difference lies. Again, coming back to the algo front, so rules. Now, as I said, again, a lot of people have these mental blockages that, oh, I don't know what kind of rules they are using, probably it's a black box. It's probably for, people who know a lot of formulas and things like that. But trust me, all of these rules, which basically some of the most, I would say, advanced or profitable algo systems in the world uses, most of these rules are simple rules. They are not complicated rules. So don't try and think that, when we are sitting behind our back and trying to make those computer programs for hours and hours and hours, we are trying to make something complicated. No. These are extremely simple rules, but executed to perfection. That is what is the whole idea. I'll give you a small example. Way back in 1980s, there's a company called Morgan Stanley. Right? It's a huge investment bank in US. They had a market-making division. You know what a market-making division is? Somebody who takes orders from the client and takes the other side of the trade and basically executes it in the market. So they had this market-making division, and they basically got an order to sell $100 million of General Motors in the market. So they were basically on the buying side. They bought it from the client, and they were supposed to sell $100 million worth of General Motors shares in the market. But after they got the entire shares and they started offloading it in the market, the shares of General Motors started tanking down, and they were not able to offload it. So then came the problem as to, how do you really basically sell that? Some bright chap on the desk basically stood up and said that, look, if we cannot sell General Motors, let's start selling Ford. Ford and General Motors, they both belong to the same sector. So, if General Motors crashes down and Ford is still where it is, at some point in time, probably even Ford should start, moving down. So they did that, and they sold Ford. And whatever loss they made because of not being able to sell General Motors, they recovered that in the Ford Motors. This simple philosophy of two sectors moving together, two stocks moving together in the same sector, gave rise to something called as pair trading. Right? And from 1980 to 1987 stock market crash, Morgan Stanley made more than $15 billion just by doing simple rules-based pair trading, because not many people in the street knew about it. So the idea here is basically, these rules need not be complicated. Idea here is to use the rules, use them efficiently, and use them effectively. And that is what basically, algo trading means to me. Idea of using the computers is very simple. Human beings have got two portions of their brain. We have got the IQ portion, and then we've got the EQ portion. IQ is the intelligent part. The intelligent part is the one that helps us identify where should I enter, where should I exit, what kind of stop losses should I put, blah, blah, blah. EQ is the part that kills us, the emotional question part. The moment I take a trade, it starts going against me, I hit a M2M loss, I start comparing that to how much of money I make on a monthly basis. If in a 1 month I make 1 lakh, and in one trade I'm losing 20,000 rupees, I suddenly start thinking, oh, 1/5 of my monthly revenues is going off in one trade, let me start cutting it down. Right? So the idea here is basically, we don't end up staying rational about our trades. We don't end up staying rational about our decisions. And that's where the EQ part or the emotional question part comes in. And that's the reason why many people, once they have made a set of rules and they've said that, this is a discipline I'm going to follow over and over again, irrespective of what the market scenario is, they put it into a computer, because computers don't have EQ. They only have the rules part. They know the rules, they'll execute the rule. They know the rule, they'll execute the rule. They don't care about M2M losses. They don't care about anything unless you shut the computer down. right? So the idea here is basically the entire process of basically putting algos into the computers is just to remove the emotional question part. But if you are a disciplined trader, if you're a trader who thinks you are mentally strong and you can actually counterfeit the market, you don't need computers. System-based rules, simple rules, followed with discipline, followed perfectly to execution, you are basically doing an algo. I know a lot of people in Mumbai who do not have sophisticated computers, who are from BCom background, but they are basically algo traders. They have made the set of rules, and they are following it consistently every day, irrespective of what the markets are doing. So, that's basically the whole idea. Anyway, let's come back, a step back and start looking at statistics, because that is basically the topic of discussion here, and why statistics is basically a bridge between understanding technicals and converting them into an end-to-end discipline. I would not say converting it into an algo, but converting it into an end-to-end sort of a strategy that you would really want to execute in the market. Idea here is, if you just look at this slide, if you use pure technicals, all right, if you use just pure technicals, which is based upon entries, let's say moving averages, based upon Bollinger Bands, based upon breakouts, based upon triangle breakouts, what would happen is, if the markets are good, if the markets are trending, for example, you're using a trend following system. Now, if you're using a trend following system in equities from May of 2014 to December of 2014, you'd have made a killing, right? Idea with technical systems is, when the markets are in the favor of that particular technical system, it would make enormous amount of money for you. There is no doubt about it. The problem occurs when the market is not in the favor of that particular technical system. So what I'm basically trying to say is that, imagine a scenario where a market is range bound for 3 years, where Nifty is moving in a range of 300 points, up and down. You use any kind of moving averages, you use any kind of breakout systems, you use any kind of high-low breakouts, range breakouts, triangle breakouts, you are bound to lose money because Nifty is range bound. And in a range bound market, no trend following system is going to make money for you, right? So the point here is, my friends, that if you're using technicals, you can make money when the markets are good. But the problem is when the markets are not good, when the markets are not in your favor, how can you reduce the losses? That is what is the point. Because if you're able to reduce losses during the time when the markets are not in your favor, during the time when the markets are range bound and you are using a trend following system, right? If you're able to reduce losses, you will be able to run your systems, you will be able to run your discipline for a longer period of time. And the entire process of basically using algos, entire process of using this rule-based system is that, you should run it every single day, like you open a shop every single day, like you open a cinema hall every single day, so that people come and actually, buy things from your shop. Same way, if I am running a algo system, if I am running a rule-based system, I should be running it every single day, irrespective of what the market is doing. Now, I don't know tomorrow whether the market is going to stay range-bound, or it is going to go into a trend, or is it going to, break down? I have no idea. It changes every single day. So how can I, as a person, use something else, use some other kind of mix, which is basically statistics, to help reduce my drawdowns? That is the first point. Second point is, can I use statistics in a more efficient manner, such that when the market is in my favor, so for example, when trend following system is in your favor, and you're using moving averages, technicals would make X amount of money. Can I use some kind of rule-based systems, statistics-based system, which can multiply that X by 3? So it can make it 3X. So the whole point is, when the market is in your favor, you make more money than what a normal technical analysis would do. And when the market is unfavorable, at that point in time, you reduce or you lose less as compared to what the markets are doing. Because if you're able to basically achieve this single objective of making more money as compared to what a normal market does, when the trend following, when the technicals are in your favor, and when the technicals are not in your favor, losing less money as compared to what a normal technical analysis would do, you can run your systems for eternity. That is what is the whole idea. All right. So let's look at some statistics. Let's look at some statistical point as to what are the kind of statistics we can basically use to improve the efficiency of our system. All right. Most of these statistics basically get derived from data distributions. All right. One of the common and the most, I'm sure you all would have heard about it, but it's just the question of applying it properly. one of the most common statistics which basically people use in any kind of algo trading called as volatility. All right. I'm sure everybody would have heard about volatility. If you're doing options trading, you would have probably used implied volatilities. But even after we use volatility as a term, most of us don't really understand, what is the implication of this single largest beast of statistics and how we can use it so efficiently in order to make a completely end-to-end system. So let me just, take 2 minutes of yours to help you understand what volatility is. All right. In this room, everybody might be having an opinion about, let's say, where the market is going to be 1 year from now. Somebody must be saying 10% up, somebody must be saying 20% down, somebody must be saying 40% up, and so on. Suppose I take the average. I take the average of, what everybody's opinion here is in terms of where the market is going to be for the next 1 year. Suppose the average comes to 20%, which means on an average, there's a consensus in this room that from April of 2015 to April of 2016, market is going to be up 20%. All right. Now, this is an average number. This is a number where there is a consensus in the market. The market is going to be up 20%. All right. Can I have a marker? Oh, it's already up. Thanks. So there is a consensus in the room that on an average, the market would be up by 20% in the next 1 year. All right? But we all know there is no Archimedes principle. Market can be way more up than 20% and can be way more down than 20% in the next 1 year. Nobody knows where it is going to be. All right? So I introduce a concept here which is basically called the volatility of the market. So let me just say that volatility of Nifty is 15%. Can everybody see this at the end? Or should I use a darker marker? All right, let me just introduce a term here where basically I say that the volatility of Nifty is 15%. What it basically means is that from 20%, I can be up by 15% or down by 15%. Suppose I'm down by 15% with respect to 20%, which means I'm at 5%. Or with respect to 20%, I'm up by 15%, so I'm at 35%. Now the theory of volatility or normal distribution or standard deviation, anything you'd like to call, basically says that there is a 66% probability. There is a 66% probability that the market would stay between 5% and 35%. Now again, we know this is also something that the market can break. Had it been 2008, market was down 55%. Had it been 2007, market was up 60%. So obviously the market can move much more outside of this particular range also. So from 35%, if I take another 15%, I am at 50%, 50. Or with respect to 5%, if I go down by another 15%, I am at minus 10. All right. Now the theory of volatility says that there is a 95% chance. There is a 95% chance that the market could stay between minus 10 and plus 50%. This is called as a 2 sigma limit or 2 times the volatility limit. We have the 1 time the volatility limit, which is at 66%, 2 times the volatility limit, which is at 95%. You have 3 times band also, which is basically at 99%. All right. Now this is basically a simple interpretation of what volatility means. Idea here is volatility is a measure of risk. It helps you identify how risky a particular asset class is. All right. So if you're dealing with Nifty here, and if I say that the Nifty's volatility is 15%, which means there is some amount of risk involved into it. If I take natural gas, suppose I say natural gas volatility is 30%. What it basically means is that the natural gas is a more riskier asset to trade as compared to Nifty. And if I take, let's say, USD INR has an annualized volatility of roughly 8 to 9%, which means it's a lesser risky asset to trade as compared to Nifty. It doesn't mean that you should not trade USD INR or you should trade only Nifty or you should not trade natural gas. What it basically means is obviously, more the risk, more the return, you know, vice versa. Risk and return go hand in hand. So, you know, if you're trading natural gas, the probability of making money is also very high. The probability of losing money is also very high. If you're trading USD INR, comparatively for the same amount of value and volume, for the same amount of value, the probability of losing money is less, the probability of making money is less. That is what is the basic idea. All right, so this is the bookish definition of volatility. Now, how do we apply this in practice is the question, right? So if you're using this in practice, how do you basically use this simple concept of volatility to take decisions on your trade and make it more effective? Suppose we take two stocks. We take DLF and we take ITC, all right? And suppose that, you know, based upon all the technical analysis you have done, I'll not get into technicals because, you know, everyone here would be taking about technical analysis. So let's assume based upon all the technical analysis you have done, you have got an entry point into DLF and you have got an entry into ITC. Everything else remaining equal, you have got an entry into DLF and you've got similar kind of entry into ITC, all right? Now you're supposed to place a stop loss. Now you're supposed to place a stop loss. Now my first question is, would you place equal stop loss for both of them or variable stop loss? Equal stop loss or variable stop loss? Variable. So would the stop loss be more for DLF or would it be more for ITC? For DLF, right? So for people who basically don't understand this, it is very simple. If you place a 2% stop loss for DLF and if you place a 2% stop loss for ITC, for DLF, moving down by 2% is like a, you know, a 5-minute event. You know, the daily range volatility of DLF is 6 to 7%. So it could just move down by 2%, hit your stop loss, and then again be back to the same place. For ITC, to move by 2% is an event. You know, something has to change in the cigarette sector probably for ITC to move down by 2%. So the idea here is, if you place equal stop loss for both DLF and ITC, you would end up hitting stop losses every time in DLF, and you would probably never hit a stop loss in ITC. Now, all your systems are correct, all your entries are correct, all your exits are correct, everything is correct. But just because you use this simple difference, you know, when we basically make these algo systems and, you know, when we present it to the clients, the first question they ask us is, Manish ji, aap log stop loss kahan lagate ho? So I say, ye nahi, fixed nahi hai, you know, it is variable based upon the volatility. Nahi, but fir bhi, you know, you will have some number to it, right? Some percentage you will have, 2%, 3%. Where do you put your stop loss? I say, I have no clue where the stop loss is. It just varies as per the volatility of that asset class. If I put a 2% stop loss on natural gas, that stop loss will be hit every 10 minutes. If I put a 2% stop loss on USD INR, it will never get hit. Right? Because USD INR never moves by 2%, or for it to move by 2% is an event, but natural gas, movement of 2% is nothing for it. So the idea here is, my friends, if you're using any kind of systems, first of all, you will have to understand what kind of asset you are trading. Are you trading a very volatile asset? Are you trading a less volatile asset? Are you trading a very less volatile asset? Just to give you a relative comparisons, historically, and this is long-term history, like 60, 70 years history, historically, commodities have been the most volatile asset class. So silver, natural gas, gold, crude, you know, they've got the highest amount of volatility. So if you're trading commodities, you need to have larger stop losses based upon the volatility. If you're trading, so the next in the batch is equities. Equities historically have a volatility of 15 to 20%. I'm talking about annualized volatility. So most of the time you see these IV numbers on the options, it would be around 15%, 17%, 20%. Right? Sometimes when the market is very volatile, it'll go to 35, India VIX kind of stuff. If the market is less volatile, it'll come to 11. The third in the league is basically currencies. Currencies usually have an annualized volatility of 8% to 10%. You know, currencies can't have volatility of 40%, otherwise the country will go bankrupt. All right? And the least of the volatile asset is basically your bonds. All right? In India, we still don't trade bonds, but in US and all, historically, long-term averages have been about 3 to 4%. All right? So you need to, and even obviously within the equities, you know, you will have DLF, which is very volatile. You will have ITC, which is least volatile. The next question which people ask me is, how do you do the calculations? All right, I'll not get into calculations because we don't have too much of time to sort of work it out and things like that. But if you're doing it in the Excel sheet, you can use standard deviation. Just go back and, you know, do a Google on what standard deviation is. There's another very you know, good way of basically looking at volatility, which is based upon ATR, average true range. All right, so if you've still not started using ATR, average true range, or volatility, you know, as a statistics in the trade that you are doing, please start using it. That is basically my first recommendation in terms of the statistics. The second important aspect here is basically related to time series. You need to first of all understand that what kind of time series are you trading upon, all right? And most people sort of don't get this correctly. So let me just take 2 minutes of yours to help you understand this. See, you need to know the frequency of your trading. When I say frequency of your trading, that means what kind of candles are you using? Everybody must be using, yes, some kind of a candle length. That candle could be a daily candle, it could be a weekly candle, it could be a monthly candle, it could be a 5-minute candle, it could be a 10-minute candle. It is not possible that you are not using some kind of a, data which has basically got some constant time interval, unless you are doing high frequency. In high frequency, you can have in 1 second 20 trades coming, so I'm not talking about high frequency. If you're doing anything on technicals, you would be using some kind of a candle length, 30-minute candle length, 60-minute candle length, 120-minute candle length. You need to understand this candle length very, 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 properly in order to basically do your analytics. So let me give you a small example. Suppose you are using a 60-minute candle length. All right. Suppose you are using a 60-minute candle length, and let's assume that you've got a long in, let's say, Reliance at 1,000 rupees. All right, and you're using a 60-minute candle length. Now you need to take decision, based upon where Reliance is. Number one, you can take the decision anytime you want. Number two, you take it at the end of your candles. What do you think is the most right way of doing it? Anytime you want, or based upon at the end of the candles? At the end of the candles. Most of the time, what happens is, if you're using volatility, the way I have basically described it, standard deviation based, what would happen is, if you're using volatility, which is just the standard deviation of returns, and calculations I'll not get into, that you'll have to find out, or maybe throw me an email after the session and I'll send you the details on what the calculations are. If you're using standard deviation for your calculations, you need to basically analyze your data at the end of your candle lengths. So for example, whenever you draw a moving average, or you draw a high-low breakout, or you do this triangle analysis, or whatever kind of analysis, you always do it based upon a 60-minute candle, or a 30-minute candle, or a 120-minute candle. Even the decision on, after a certain period, let's say my one candle has passed, 60 minutes has passed, should I add more to my position? Should I decrease my position? Should I cut it at the stop loss? That decision needs to be taken at the end of those 60 minutes. After another 60 minutes, assuming you're still in the trade, after another 60 minutes, again you need to basically, review the same thing. Should I add to my position? Should I not do anything about it? Or should I, cut it at a stop loss? All this decision basically needs to be taken at the end of your candle length. And that is why even the calculation of these volatilities, right, is dependent upon what kind of candle length you are using. So if I'm using a 60-minute candle length, I would be calculating my 60-minute volatility. Volatility is a function of time. So when I say that this number, standard deviation, is 15%, I'm talking about annualized volatility. That means in 1 year, this market can move so much. But if I talk about a 5-minute volatility, or if I talk about a 10-minute volatility, market cannot move by 15% in 5 minutes. Markets cannot move by 20% in 5 minutes. It can only move by probably 1%. It can only move by probably 50 basis points. So in that case, my volatility is going to be lesser. Right? And that's the reason that whatever candle length you choose, 60-minute candle length, 120-minute candle length, based upon that your volatilities are going to be different. Higher is your candle length. If I take a daily candle, or if I take a weekly candle, or a monthly candle, my volatility numbers are going to be larger. If I take smaller candle lengths, my volatility numbers are going to be smaller. Which basically means that if I'm taking smaller candle lengths, my stop losses are going to be smaller. If I take a larger candle length, for example, if I take a weekly candle length, obviously my volatilities are going to be larger, and so my stop losses are also going to be larger. If I'm entering Reliance today at 1,000 rupees, and I'm evaluating that at the end of every week, then obviously I need to give it a 10–15% room to move. But if I'm trading Reliance at the end of every 10 minutes, I don't need to give it a 15% room to move. Probably a 1% movement is enough. So volatility is not just the function of normal calculations, but it is also a function of what time series you are using. 60-minute time series, 120-minute time series, daily, weekly, monthly, yearly, decades, whatever, XYZ, right? So you need to be crystal clear about it. And that's the reason why people like high frequency these days, because my decisions are very fast. Buying decisions are fast, selling decisions are faster, volatilities are lesser, stop losses are much tighter, and things like that. But given the scenario in this country, and given the execution cost, it's slightly a challenging thing. All right. So much on the volatility. Now let's talk about the next important. So I've already talked about volatility. I'll not show you complex calculation formulas because it will put you off. But let me help you understand these things more practically. The next important statistics that you need to basically bear in mind is what is called as correlation. All right. Now what is correlation? Correlation is basically a mathematical term which says that if A moves up and B also moves up, based upon the fact that A has moved, they both are positively correlated. All right. Negative correlation is if A moves up and B moves down, they are negatively correlated. All right. So if I'm saying that A moves up and B moves up, they are positively correlated. Now if A moves down and B moves down, are they positively correlated or negatively correlated? They are positively correlated. All right, because they both are moving down. But if one moves up and the other goes down, they are basically negatively correlated. Right. Now again, I will not get into the formula of correlation. In Excel, you can just do CORREL correl, and you can get the correlation. Or you can do a Google on what the what the formula for correlation is. But I'll try to help you understand practically, how correlation is such an important statistics to basically make an end-to-end system. All right. And again, I'll do this with a small example. Suppose you're using a trend following system. All right. Suppose you're doing a moving average based system, and you have got a portfolio A, which comprises of Axis Bank, HDFC Bank, and ICICI Bank. All right. So that's my portfolio A, which has got Axis Bank, HDFC Bank, and ICICI Bank. And I'm doing moving average or trend following based or these kind of thing on basket A. All right. I've got basket B, which basically comprises of ONGC, Infosys, and ICICI Bank. All right. So please, I'll tell this to you again. Basket A comprising of Axis Bank, HDFC Bank, and ICICI Bank. Basket B comprising of ONGC, Infosys, and ICICI Bank. All right. Now, if I were to do a moving average or a trend following based system on this, would you choose basket A or basket B? Basket A, how many people? Okay. Basket B? Okay, I think we have an equal distribution on basket A and basket B. Now, what is the problem? Which basket you think has got higher correlation, basket A or basket B? A has got higher correlation, right? Axis Bank, HDFC Bank, and ICICI Bank, they all three belong to the same sector. So, wherever your bank nifty is going to move, plus minus the beta of the stock, that much is going to be the movement of that particular basket, right? Now, what happens if you choose basket A for your trend following system? The biggest problem is, if bank nifty goes sideways tomorrow for 3 months and gets stuck at whatever 16,000, 17,000 levels and doesn't move, for the next 3 months, you're going to lose money in all three of your stocks. Your Axis Bank, HDFC Bank, and ICICI Bank, they all are probably going to go move sideways. And if they all three start moving sideways at once, you're going to lose 3 times the money by doing your trend following system. Right? So, you intuitively understand that the correlations in basket A is higher and the correlation in basket B is lower. But practically, when you are actually doing this, and this is what happens with many of the technical analysis, that if bank nifty is going to give me a breakout, a 20-day breakout or 30-day or whatever breakout you're looking at, most of the banks will also give you breakouts. Right? Because you've got high correlation between bank nifty and all of these banks. So what people end up doing is they end up buying Axis Bank and HDFC Bank and ICICI Bank and all the banks where they've got the breakout, without realizing the fact that they're basically putting all their eggs in the same basket. Tomorrow, for whatever reason, that's a false breakout in bank nifty and bank nifty is back to the same level, all of these banks are going to basically drop down and you're going to lose money into them. Right? But if you're doing basket B, which basically comprises of ONGC and Infosys and ICICI Bank, what you're basically doing is, for whatever reason, if bank nifty goes sideways for 3 months, you at least have software moving, you at least have oil moving, you at least have something which is moving in that particular basket, which is making up the money for the ones that you're going to lose in the other two. Right? So the idea here is basically by staying diversified in terms of being in a non-correlated asset classes, you are making sure that if the market goes sideways or if a particular stock goes sideways, you are losing money in that particular stock, but you're not losing it in your entire portfolio. In that entire portfolio, at least something is moving and basically making money for you. You see, if I'm doing this systems which are basically, tradable systems on a day-to-day basis, which I'm going to run for a very long period of time, I need to make sure that, I choose my basket very carefully and don't be in a situation where, I'm doing Bank Nifty multiplied by 3 times, because then I run into the risk of the fact that I got my technicals correct, I got my stop losses correct, I got my exits correct, I got everything correct, but I got my portfolio wrong. And because I got my portfolio wrong, I'm losing 3 times the money, by doing all the hard work. In fact, people in the West, the hedge funds industry, they go a step forward. They say that, we don't even like trading stocks together, because if you do stocks, idea here is basically give or take the beta of the stock, you're ultimately trading the Nifty. If Nifty basically goes into a trend, 70% of the stocks will be in upward trend. If Nifty goes into a downward trend, 80% of the stocks will be in downward trend. Right? So what you're basically doing is you're just doing Nifty multiplied by 10 if you're doing 10 different stocks. So people go a step forward. They say, you know what, I'm going to trade natural gas, and I'm going to trade gold, and I'm going to trade USD, INR, and Nifty. Now you're doing 4 different things which has got no correlation with each other. Movement of natural gas has got nothing to do with movement of Nifty. Movement of Nifty has got nothing to do with movement of probably silver or gold. Of course, there's some amount of correlation, but let's just forget about it. So the idea here is, whenever you're doing any kind of trend following systems, any kind of averaging based systems, it is important that you stay in diversified asset classes. If you're doing investment, is the other way around. If you're like a Warren Buffett kind of a school of thought, then you want to put all your eggs into one basket by buying Coca-Cola's 10% share. It's a different thing. But if you're looking at trading, and if you're trying to make a system which you can basically run for a very long period of time, you need to stay diversified. That is the idea. All right. So again, I'll not get into too much of details of how you can do the calculations of correlations, because you can go through all the standard textbooks to do that. But the idea here is basically correlation is another very important study that goes in as a part of statistics to make sure that you make a tradable system which is very efficient. All right. Now I'll basically get into the third one, which is essentially to do with mean reversions. All right. Now I'm not sure. I don't think too many people here do pair trading. But let me just give you a small example, to help you understand, how basically you can make a very efficient mean reverting system. All right. See, just 2 minutes of what pair trading is. Pair trading is, when you have 2 stocks belonging to the same sector, which basically got divorced in the short term. All right. So just imagine HDFC Bank and ICICI Bank being trading in the market, and suddenly you have a situation where ICICI Bank goes too much above, and HDFC Bank is where it is. You take a short position in ICICI Bank and long position in HDFC Bank in the hope that they basically revert back, right? Imagine it like a situation where, you have a husband and a wife. In the short term, you always have situations where they end up being in a fight. But, after 2 days, 3 days, they basically make up in a fight and then they come back, unless the situation goes into a divorce, where FCIC and ICICI Bank just goes, way apart. So the idea here is, if you're doing any kind of mean reversions, if you're doing any kind of areas where you're trying to do an arbitrage, front month, next month arbitrage, cash future arbitrage, arbitrages between, gold mini and gold mega, arbitrages between any kind of things, you would basically need some kind of a mean reversion technique, all right? The classical way in which basically I help people understand, this statistics is, imagine a situation where you have a drunkard guy, all right? You have a drunkard guy who's just out of bar and walking on the road, all right? His walk, more often than not, would be a random walk, right? So he would basically be walking the way I was 3 days back, basically, just having a random walk. Now imagine a dog which has just started moving along with this guy, and the dog is also having a random walk, all right? So you've got the drunkard guy, and then you've got the dog. Both are walking on the street, and they both are having random walks, all right? Now you attach a thread between the dog and the guy, and look at the movement of that particular thread. So what would happen is there will be a situation when the dog and the drunkard guy would come together, and then they would again deviate apart. Again come together, and then again deviate apart. So you are having a case where the dog is having a random walk, the drunkard guy is having the random walk, but the thread which is attached between them has got a mean reversion property. Going apart, coming back, going apart, coming back, going apart, coming back. Similarly, even in the case of stock markets, you have situations where you have 2 stocks which could be random walk. ICICI Bank and HDFC Bank could individually be having a random walk. But the thread which is attached between them, which could be the ratio or the price difference or whatever you'd like to call, that can have a mean reversion property. All right, and basically, when you're looking at arbitrages, you're looking at pair trading, you're looking at anything, what you're trying to find out is the behavior of this thread. The behavior of the relationship between HDFC Bank and ICICI Bank. Is this relationship mean reverting in nature or not? All right, how do you identify that? Well, there are some very standard methodologies available. There is a methodology called co-integration. All right. What basically, again, I'll not get into the maths of co-integration. You can again, go and basically do a Google upon it. But it was basically found by a guy, by two people called Dickey and Fuller, and it's basically called as a Dickey-Fuller test, where what you do is, you take the time series. So, for example, I take the price of ICICI Bank, I take the price of HDFC Bank, and I take the ratio of that price. All right. So, I'll take the ratio of ICICI Bank's price upon HDFC Bank's price. I would get one single ratio. That particular ratio is basically your thread. Now you want to identify whether this thread is mean reverting in nature or not. So you take that ratio and you put that into a co-integration test. All right, you put that into a co-integration test, and the result that you get from that helps you identify whether this thread is mean reverting in nature or not. So most people, when they do an arbitrage, like a front month, next month, or a cash future is more or less always mean reverting, so I don't need BSE NSE arbitrage and all are always mean reverting. But anything which is a risk-based arbitrage, so for example, your HDFC ICICI Bank or your Infosys TCS, anything where you have risk of holding one stock against another, you always have to be in a situation where you have to identify whether this particular time series, which is the relationship between these two stocks, are mean reverting in nature or not, right? So you can use co-integration as a test. There's another test called variance ratio test. I cannot get into the maths. I don't have too much of time. Trust me, I take usually a 2-day program to just help you understand these maths. So I'll not get into it, but I'll just give you the names. You can always go back and do a internet search upon it. There's one called variance ratio test, very powerful. Usually variance ratio, if you take this particular ratio and you do a variance ratio test, if the number comes out to be less than 1 of your variance ratio test, what it basically means is that the series is highly mean reverting in nature. And if your variance ratio test number comes out to be greater than 1, it basically means that the series is diverging in nature. You can use this particular test to even do trend following system. So you can say that if my series is very highly mean reverting in nature, I will not do a trend following upon it. Because then the chances of this series losing money becomes higher. But if the series is diverging in nature, which means if the variance ratio test numbers are greater than 1, I would do a trend following system upon it. Right, so you can use this for trend following systems, you can use this for pair trading, you can use it for any of these purposes. All right, so you can use variance ratio test, you can use co-integration. If you are really mathematically savvy, there is one more test called as Unsten-Uhlenberg test, very effective, used by a lot of hedge funds globally, to identify if a series is mean reverting or not. All right, so there's a test called Unsten-Uhlenberg test. Just type OU on Google, OU process, you'll be able to find that test. So all of these tests are very effective in terms of identifying whether a time series has got inherent mean reverting behavior or not, right? So that's basically the idea. Then there is another statistics. So there's just one small example. It just helps you identify. Where's the PPT? That's okay. There is another very powerful statistics called PCA, Principal Component Analysis. So if you come from a value background, if you come from a background where price to earning ratios and price to book ratios and dividend yield excites you, you should look at principal component analysis. What it basically does is that you give the set of stocks as input to principal component analysis, and you give all the PE numbers, PB numbers, dividend yield numbers, EV EBITDA numbers and things like that to that particular component. The output resultant would be, it will basically classify those entire set of stocks into pockets, where it would say that these are the stocks which belong to high PE, high PB, high EV EBITDA. These are the stocks that belong to low PE, low PB, low EBITDA and things like that, right? So you can basically do a classification. It's called cluster analysis. So you can do basically clustering of stocks based upon principal component analysis. Again, I cannot get into too much of details of that as well because that's something which is outside the scope. So these are the important statistics, which basically I feel is important to sort of take things to the next level. Now I'll just take another 10 minutes of yours to help understand that when we basically build these trading strategies, what are the other considerations we look at, apart from the technical entries and exits, to basically build a very meaningful system, all right? Now, You see, broadly speaking, any trading strategy in the world can be classified into two categories. One is momentum, and the other is mean reversion. All right? When you're doing a momentum-based trade, what you're doing is you are basically trading with the flow of the market. So, for example, if I say that I'm having a channel breakout, all right, I'm having a channel breakout and I'm entering a long position. Am I doing a momentum or a mean reversion? I'm doing a momentum, right? Because it's a channel breakout and I'm basically going with the flow of the market. Market comes to the support line and I initiate a buy. Am I doing a momentum or a mean reversion? Market comes to the support line and I'm initiating a buy. Am I doing a momentum or a mean reversion? Mean reversion. Why? Because I'm going against the flow of the market. Market is actually coming down. I expect it to basically come to the support and I'm buying at the support. So I'm doing a mean reversion. All right? There's a moving average crossover and I initiate a buy. I'm doing a momentum or a mean reversion? Momentum. RSI is at 80 and I initiate a sell. Am I doing a momentum or a mean reversion? Mean reversion. So now you understand what a momentum is, what a mean reversion. Right? Now, everybody in this room will have your own styles of playing. It could be a momentum style of playing or a mean reversion style of playing. All right? And you can keep on debating as to which one is better. I will not get into that debate. What I basically want to highlight is that momentum and mean reversions are nothing but same side of the two coin. It's like Tendulkar is also a great batsman, Sehwag is also a great batsman. But they both have their own styles of play. The way Sehwag plays is, if he's there on the crease for 6 balls, for the first 4 balls he'll not do anything. Right? And he doesn't like running, so obviously he'll not run. 5th ball comes, it's a loose ball, he'll hit it for a 6. And then again, probably he'll not do anything for the 6th ball. What he has done is he's got an average of 6, but he's got an average of 6 in 6 balls. If you see a person like Tendulkar, he would come to the crease, and every single ball he would try to take 1 run. If he has missed 1 ball, second ball he would probably try to take 2 runs. What Tendulkar is doing is, he's playing every ball and try to take small bits of money out from the small bits of runs out from every ball. What Sehwag is doing is, he's basically going for the momentum. He's going for home runs, where he's saying 1 ball in an over is enough for me to make that 6. Right? If you're doing a momentum-based trading, you are Sehwag. If you're doing mean reversion-based trading, you are Tendulkar. If you are doing a momentum-based trade, where you are saying that, I'm having a breakout, I'm having a moving average crossover, I'm having a triangle breakout, whatever XYZ things, you have to go for a home run. When I say home run, it basically means you cannot get out of that trade with a 2% profit. And I see this is the problem with most people that, they get their entries right, they get the moving average right, they get the breakouts right, but the moment there's a profit of 2%, they're out of the trade. 2% ban gaya, 3% ban gaya, 5% ban gaya, they're out of the trade. Right? Whereas that ball is basically your momentum ball. You have to hit it for a 6, you have to go for a home run. You see, market stays in momentum only 30% of the time. 70% of the time, markets are range bounds. Right? If those 30% of the time when the markets are trending, you are not making money, based upon the momentums you have, you will not be able to feed your losers. When I say feed your losers, that means those 70% of the time when the markets are range bound, and if you're not making money, this 30% of the time is not enough. The era of 2002 to 2006 bull market, once gone, is gone. It's not going to come back. Probably the May 2014 rally has come and it's gone, it's gone. We don't know again when the rally is going to come. But when those rallies come, if you're not going for the home runs, right, if you're not going for those 15, 20, 25% move, you will not be able to feed your losers, which means when the market goes range bound, you'll not be able to make money. So if you are doing any trade which is based upon momentum, which is based upon trend following, which is based upon breakouts, please make sure that if you have bought something at 100 rupees, and if it goes to 102, don't cut it. You should always add to the position. If it again goes into your favor, you should always add to the position. Because if you add to the position, 1 time, 2 time, 3 time, what you're basically doing is, if that trade basically, makes your 10%, 15% return, you're making it 3 times the amount. All right? And at the same time, you need to have tight stop losses for these kind of trades. So if I'm entering at 100, I probably will have, based upon the volatility of that particular stock, I will have, a stop loss, which is, if my target profit is 15%, my stop loss should be 2%. That is what is the idea. All right? Because these trades are successful only 30% of the times. If I'm doing a mean reversion based trade, what I'm doing is, I'm not going for home runs. Imagine a situation where a stock comes to the lower Bollinger, and I initiate a buy. I would only expect the stock to go back to the middle level, which is the middle Bollinger, and book a profit. That could be a 2% profit, it could be a 3% profit. I'm not going for a 50% profit or 15, 20% profit. It has come to the lower Bollinger, I've initiated a buy, it has again gone back to the middle Bollinger, I'm out of it. A stock has come to a support level, which is like a midterm support level. It's bounced back from there 3%, 4%, 5%, I'm out of it. I'm not going for the long trends there. What I'm basically going for is singles. So when you do singles, based upon mean reversion based trades, what would happen is out of 10 trades you do, 7 will be successful, 8 will be successful. Why? Because mean reversion properties of the markets are such that 70, 80% of the times market is in the mean reversion phase. But when I'm doing momentum trades, out of 10 trades you do, only 3 will be successful. Try doing a channel breakout, try doing a flag breakout. 30%, 40% is the success rate. Today when we go to US and present our strategies, if we tell to them that we are doing a momentum strategy and we've got a 70% success rate, they don't even look at it. They say probably your models are over-optimized. You cannot have a trend following system which has got a success rate of more than 30 to 40%. When I go to India and explain the same thing to investors here, they say, Manish ji, आप तो 30% time में successful होते हो. 70% टाइम तो आपका ट्रेड्स पैसा लॉस करते हैं ना, तो नेट नेट तो आपका पैसा लॉस ही हो रहा है. It's very difficult for us, to help them understand that those 30% of trades which are successful, we make more money as compared to those 70% trades where we are losing money. So where those 70% trades where we are losing money, we are losing small bits, 1%, 2%, 1%, 2%. But those 30% trades, they are successful for us, they are making 15, 20, 25% kind of returns. And net net, if you eventually, add up both the things, you end up making a killer. That is what is the whole idea. If you look at, so classical example is currencies, in 2013, that May, June, July, August rallies, because of our trend following system, we could basically generate so much of money that, after that currency has virtually been in a range bound phase over the last 1 year, 62.5, 63, and it has not moved. But none of our clients ever came back to us and said, we are losing money in currency. Because the amount of money that got made because of that one big move of 3 months was more than enough to capitalize the loss for the next 2 years. Right? So we are able to run the systems systematically in a more disciplined fashion without getting excited about it, just because we could make money, when we had the right opportunity. And when the opportunity was wrong, we are losing small amounts of money, not losing a huge amount. All right? So these are some of the key factors in statistics that we need to basically look into. I think I've taken my 1 hour here, right? So with this, I come to an end of the discussion. Any questions, any doubts, please, should I take it now or later? All right. So, we'll do it later. Any questions, any doubts? You can just Google my name on Manish Jalan on Google. You'll find out all the details about me. Thanks a lot.